Hi, I'm Tom Mihawk. Welcome back to my online personal finance course. This chapter is called Housing Selection and Financing. This is the second of two of this chapter. And I mentioned at the beginning of the first one, this is exciting because this is the last chapter I'm recording. This is literally the last video. This is the second of two for this chapter. So I'm really excited about this one. You can find me at LinkedIn, of course. You can find me at tommihawk.com under resume optimization, Twitter, and Instagram. And I mentioned a book in these last few chapters. It just came out this week, and I wanted to show you that it's available at Amazon. I know it's very small, but it's called Optimize Your Resume. And you can see right there, there's a, let me see, wait, it's a little bit bigger. Right there is a banner, red banner. It's #1 new release. It hit #8 this week in its segment, the job hunting resumes. I mean, not #1 in all of Amazon, but it's #1 in job hunting resumes. And Amazon does a great job. They run these little specials. They put a little banner there. If you look this morning, it's not there. This was yesterday. And so, you know, it's depending on when your sales, which tells you I've sold some books already, which is great. If you're interested in careers, in getting a better career, competing against others who are talented, and showing your talent, the book will be great for you. Try it at Amazon. Optimize Your Resume. We're talking about housing selection and financing. We talked before about renting, and now we're going to talk about ownership, the home buying process. First, there are 4 or 5 sections in this home buying process. First, determine your home buying needs, the size, location, location, location. I didn't reprint that by mistake. I repeated that on purpose because location, location, location is probably the most important thing, if not definitely the most important thing about home ownership. And features, single family home, a building, right? Or a garden apartment, condominium, a build yourself, you know, on-site versus a manufactured home. Now, manufactured home and mobile homes are different. I had a client once, very nice man, did very well for himself, sold his business, and it was a manufactured home business. And I one time said, Charlie, you know, how did you do so well for yourself selling your mobile home business? And he said, no, Tom, not mobile homes. He said, manufactured homes. We make them in a warehouse. The climate conditions are always the same. It's dry. It's comfortable. Our people can work in all conditions outdoors. We then put the part of the home on a truck and ship it to the job site and attach them together at the job site. Now, some people think that that's not, you know, as durable a way of doing it as building it up from scratch. But imagine that you can put the appliances in, put the light switches in, all those things in a warehouse where it's clean and dry and comfortable. So he did very well for himself, and I have been since then in a very nice community in a manufactured home, and it's gorgeous. You can't tell that it's not made from the ground up, you know, piece by piece. It's gorgeous. So if you build, contractor selection is critical. Presence of and managing subcontractors completely magnifies the challenge. You know, forgive me if you or your family are contractors, but you know, if you could be timely and you're good with your hands, that's a hard combination to find. Usually people are good with their hands or they're timely, but not usually both. And so when a contractor says they're going to be finished in June, what they mean is August often. And so managing subcontractors makes it even more challenging. Certainly consider the reputation. Get references, but consider progress payments. Don't pay up front. You know, pay as the work gets done. I learned this selling industrial air conditioning when I was an undergrad engineer right out of undergrad before grad school. You know, I worked on large commercial and industrial equipment, and there were always progress payments, and you didn't receive all your payment for your job until it was completed, and the punch list was gone through, and every item was completed. Expect delays. Be happy if you don't have any. Again, you know, June usually means August completion. Look to see if the contractors are licensed and insured. Get a written contract. Home ownership, advantages versus disadvantages. We're going to go over those now. Pride of ownership, lifestyle stability, and community are advantages. I remember when I had my first home, I was in Connecticut. I can remember the kids were finished playing. They were going in for a bath. I was standing outside. Maybe I'd finished just cutting the lawn. I don't remember. but I was standing on the driveway looking out. The home was over here, looking out at a tree and saying, "Daggone, that's my tree." Now, I know maybe that sounds dumb, but that was a big deal to me. Damn, that's my tree. Now, I know now, I mean, I've lived in the home I'm living in now for 25 years, and even at that, you feel like you really only rent it, right? You rent it for 25 or 30 years instead of renting for a year or two. But still, there's pride of ownership. Lifestyle stability, you know, I support my community. I'm involved in standing up or trying to decline certain construction or other activities or changes. Our kids were educated nearby. We attended school sports events and high school sports events. And so you're part of the community. Financial advantage. Mortgage interest is deductible. Property taxes or other deductions. As you know, deductions lower your pre-tax income, which lowers your taxes, right? Because you're expensing them. You're reducing your pre-tax income by subtracting these, which lowers your taxes. You have equity. The difference between the value of the property, subtract the mortgage from the value of the property, and the difference is your equity. And if your home value goes up over time, your equity goes up in value over time. Disadvantages. Speaking of financial, right? Home ownership is expensive. There's a down payment to pay, usually 20%, not always, but usually 20% of the value of the property. Home values can decrease. I can remember when we lived in northern New Jersey, I was working in Manhattan when I was right out of grad school. And we had friends that owned condominiums, and people, you know, competed to get into these condominiums. And then 3-4 years later, there was a recession, and it certainly affected Wall Street and people who worked there. And these condominiums went down in value. And for a while, several years, friends of ours were underwater. They had a loan for, I don't remember, $200,000, and their property is worth $175,000. That was a big deal. Obtaining and servicing a mortgage, being able to pay your mortgage interest is important, and getting a mortgage, period, can be challenging. Increases in property taxes, even though they're deductible, they can go up. And so it can be expensive. Limited mobility, as we said earlier. Can you sell your home in a month? Sure, but do you want to? No. And expect regular repairs, required maintenance and upkeep. You're going to have your lawn cut or cut it yourself. Have your bushes trimmed, put down mulch, remove soil or add soil near the house. Things break, and they seem to break and need repair all the time when you own a home. Second, in the home buying process, find and evaluate property to purchase. Location, 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 again, most important thing. Using a real estate agent, they charge you. Don't forget the real estate agent usually serves the seller, not the buyer, although there are buyer brokers and you can work this out. But the agent finds properties to look at, arranges visits, negotiates price, can assist you in obtaining financing, can represent you or help you at the closing. You're going to have to do a home inspection, an appraisal, and a title search required for the mortgage. Title search means the people selling have the right to sell the property. Appraisal helps you figure out the value of your home. And the home inspection can be an important negotiating tool when you find out that the roof needs replacement or there are leaks in the shower or those sorts of things. Any mortgage requires a home inspection so that they know what they're lending against. Pricing the property. You can look at recent sales. Zillow, everyone now knows about Zillow.com. It's not 100% accurate. Seems like it's a little bit high what it lists. I mean, it uses algorithms to price properties, I guess, across the globe, but certainly in the U.S. And mine just went up. It's great. You know, I looked one day recently, and it just popped up, which was terrific. Look at the current economy, interest rates, where they're moving. Interest rates have been low now for a while. I think that contributed to my home going up in value. And lots of sales in the United States lately and lots of refinancings. The demand for housing. You know, is demand for housing high? How long have the owners lived there? If they've lived there a long time, they might accept a lower price. You know, they bought it here and really low, and they want to sell it here. Maybe they'll accept this because they've lived there a long time. Look for the condition of the home. We always felt we bought the crappy house in a good neighborhood. It needed a lot of work, and we've now 25 years later done almost everything we needed to do. Not everything. We have a few things left, but not much. And that gave us a great opportunity to buy a home at less expensively than many in our less expensive than many in our neighborhood. And we have many beautiful homes in our neighborhood, and our home is beautiful too, but it needed some work. And the home's features, things like a pool, 3-car garage, large master suite, those things can add to the cost. Entertainment centers, those things can add to the cost of the home. So decide if you want or need those. Offer and counter offers are involved in negotiation. The buyer has to be able to obtain financing. Their contingencies might be negotiated, such as, the sale of their current home before they can take the home that they're bidding on. The appraisal and the inspection impact the negotiation. Expect to negotiate. When we bought our home in here, they wanted this, and we bid this. They came down to here, we went up to here. They came down to here, we went up to here. The family had lived here a long time. They wanted to get out. They were sitting on a large amount of capital gain. As I said, they maintained it, but not in the best condition, and that was our opportunity to buy at a discount. So those things can be a benefit for you. And in some states, you have to have evidence of the ability to finance the purchase before we even can bid. Not all states are like that, but many are. So to obtain financing, section number 4 in the home buying process. Research lenders. Try your bank. Look for lenders you see advertised online or in publications, magazines. Know the most competitive rates. You should know what a competitive rate for a 30-year or 15-year fixed mortgage is. In other words, know the current market. Approach lenders preliminarily. Ask them, what information they need. Get a sense for whether you would be accepted or not, approved or not, and determine your comfort with them. Are they large, online, telephone-based, doing many mortgages? You might find those work out well. You might find they have good rates. They may not. And you might want something that's a little bit more personal, like from a small local bank where they can make maybe a few more exceptions and don't necessarily resell their mortgages to Fannie Mae and Freddie Mac, where they have to fit certain, characteristics that they can't change. Smaller banks can maybe make some modifications, and you would have more chance of being accepted, or maybe get an uncommon type of loan or something like that. Qualifying and applying, we just talked about large and small lenders. You have to submit your income, your net worth, your expenses, your tax returns, W-2s, and other evidence of your income. The lender will will definitely request a credit report, which is called a hard inquiry. And so it'll be recorded and will affect your credit score. It'll go down a little bit because of this. If you try several mortgage lenders, 2 or 3, each of them do a hard inquiry, it's going to affect your credit score somewhat. It comes back, but not, the next week. I mean, it takes some time. Points can be used to lower your mortgage rate, but they're assessed as 1% of the loan amount, meaning that if you're borrowing $400,000, 2 points are $8,000. So you're financing more of your loan. It can lower your rate and therefore lower your payment, but you're going to be paying more over the life of the loan. You're effectively buying down. By financing more, you're buying down the rate to get a lower monthly cost. Mortgages come in terms of 30, 20, and 15 years, and others 10 fixed mortgages. And there are no rate changes during that time. Adjustable mortgages have fixed terms of 1, 3, 5, 7, and 10. Maybe others. Those are the most common. The rate is fixed for that term, and then it varies subject to certain limits and caps. So, it's not going to jump 10% in 1 year, but it can jump maybe 2% or maybe even a little bit more. And there are limits, annual limits, on how much the rate can increase. The loan is amortizing. Mortgage loans are amortizing, meaning that there's part interest and part principal paid. Principal meaning the loan balance. Interest is the fee you pay the lender to give you the loan. All loans are almost all interest initially and very little principal, meaning you don't pay the loan down very much in the beginning. But over time, those two reverse, they flip-flop, such that at the end, you're paying almost all principal down and very little interest. You have a lot of deduction on your taxes in the beginning and very little at the end, but at the end, you're paying your loan down faster. Your home is collateral, which means that the bank takes your home if you don't make a payment. Not in 1 month or two, but if you're not paying for 6 months, the bank is going to foreclose and take ownership of your home. But this makes it possible, not the foreclosure, but using your home as collateral makes it possible for more people to get loans and lowers the rate. There's less risk for the lender. Watch the fees at the close. Those fees are included in what's called the annual percentage rate. It's not simply the interest rate that determines your cost, but all the fees too, which are indicated by the APR. Shorter loan term means higher monthly payments, but less total cost. Lower interest rate means lower monthly payments and less total cost. Again, look for the loan term and the rate. The rate is probably the more impactful, right? Lower rates mean lower payments, less total cost. Shorter loan terms mean higher monthly payments because you're paying it faster, but less total cost. Other types of mortgages, government programs, interest only can be dangerous. Be careful. If you're in an expensive area, they can help make the mortgage more affordable, but they can be risky, so be careful. Home equity lines of credit offered by banks on the equity that's not included in the collateral of a first mortgage. Get those. They're valuable to apply for and obtain them when things are good, when your home has high value, when you're having good years at work and earning well and your net worth is higher. If you need to use them then in the future when maybe you're starting a business, maybe your net worth is lower, maybe if you started a business and maybe your earnings are not so great, the bank won't lend to you then. So get a home equity line of credit and keep it paid off if you can. If you use it and it's interest only, be careful because your payments may not lower the balance. So be careful. Reverse mortgages are used by people who have home equity and need income. Often they're used, late in people's senior years, later in life. You pay a fee though to get monthly income. Somebody has to track it and calculate it and send receipts and send payments and things. If you take a course like this, consider other ways of borrowing to fund your later years. Not just, and I'm not saying reverse mortgages are bad. For some people, they're probably great. I'm just saying, if you take a course like this and you're interested in personal finance, there may be other better ways to borrow that require a little bit more work on your part, but save you money. Preparing your home for sale. Eliminate clutter. Remove personal effects that date you or put you in a bad light for someone who might come and look at your home. Repaint, repair, clean. Have your lawn cut and your plant materials trimmed and clean, right? When showing, make the home look comfortable and attractive. Turn lights on, open drapes, brew coffee, have bread smells or good food smells. It's like when you go to some restaurants and they pump the aroma from the kitchen outside, or the people tell me some people tell me I'm wrong about this, but I'm pretty sure the Panera Bread pumps the bread smell outside the front door to draw you in. It's an attractive aroma. It makes it exciting and interesting. Staging. You pay a fee to have someone prepare your house for you, that you can use your furniture or they'll bring in furniture. It can reduce the time for the sale or increase the sale price. If you have to move to take a new job and the home is vacant, bringing furniture in and personal effects can make the home look attractive and help you sell it. And the closing. It's the meeting of the buyer, the seller, their representatives, the legal real estate agents. For signatures, indicating acceptance of the terms and transfer of ownership. Closing costs are numerous and they add up. Title insurance and title search, attorney and appraiser's fees, the credit report, lender's fees, prepaid interest. The point is, you get these things the mortgages come in like 8.5 by 14 pages, these long pages, right? And closing costs are so high. Talk to your lender, try to get your costs lowered. Track them, ask them, what is this fee? What is this fee? What is this fee? Because when they give you the copy of the mortgage and a bunch of documents this thick, you can look at those things. These are the things that add to your APR, add to your cost. So ask about those things, okay? This is the last slide of my online course. This chapter is called Housing Selection and Financing. It's the second of two. I'm Tom Mihawk. You can find me at tommihawk.com, at my YouTube channel, at Resume Optimization, at Twitter and Instagram, and at my new book called Optimize Your Resume. The electronic book is out now, but the paperback will be out very soon. This week it was number 8 in its category and a number 1 top seller. Thank you very much for watching. I'm really excited to have this now available at my YouTube channel. Enjoy these courses. Thank you for watching and take care.